As we finish our second quarter forecast, we anticipate the next 12 months to be a continuation of the current recovery. It is still supported with extremely easy monetary policy and very strong fiscal support that we've never seen before, really. And this recovery, though, will be a bit of a balancing act between the reopening of economies and the flaring up of the pandemic. Our positive tilt towards the continuation of the recovery and no major flare up is partly related to this fiscal and monetary support, but also the positive news on the medical front, which continues to be improvement in conduct by the general population, as well as there's also good news on the vaccine front and new therapeutic that helps reduce hospital stays. Of course, there are some risks to this scenario. We highlight them in perspective. I guess some of the ones that we would highlight, the US election later this year is a risk, but I would venture to say that it's a two-way risk. On the one hand, it is expected that if a Democratic government would come in, they would reverse some of the decline in corporate taxes and increase spending in education and healthcare. But on the other hand, that would likely also mean the end of or reduction in tariffs, which would probably be positive. And also from a global coordination perspective and geopolitics perspective, it might ease a little bit some of the current conflicts that exist. There's oil that is also a risk in the sense that the OPEC plus agreement is still fragile, and if they were to increase production again, oil prices could plunge, which would probably be, particularly for Canada, would be a risky scenario for Canada. And there's always the bilateral US-China conflicts that could continue to heat up, particularly on the tech side. That remains to be a risk, but we see them more as risk rather than a main scenario. So from a strategy perspective, we have continually recommended investors in this time of continued degree of uncertainty to diversify as broadly as possible. And we always recommended to go beyond the traditional asset classes. And that some of these recommendations still stands. Like we've seen gold, for example, which we have recommended as a hedge within a portfolio, has done extremely well. And that's been helpful in a portfolio. I think the challenge for a traditional balance fund going forward is the starting level of government bonds that are very low and won't play as big a role in balancing a portfolio as in the past. So again, this heightens the necessity to broadly diversify a portfolio. And that could also be, therefore, diversifying towards corporate, high-grade corporate bonds. We see that central banks have supported the corporate bond market following the pandemic, and that provides a certain degree of cushion and a higher degree of yield from fixed income. Emerging markets, both on the bond perspective and on an equity perspective, are still relatively attractive. From that perspective, that's a good diversifier. And as usual, quality stocks and portfolios, ones that are not necessarily too expensive. We could also see from our research for this quarterly forecast, Europe doing a little bit better. There's a rescue fund that's coming into Europe. That's going to provide a degree of fiscal support. And Europe has dealt better with the pandemic than North America or than the United States, really. And so that gives a leg up in Europe, as well as Asia in general, that have dealt better with the COVID and are further ahead in their reopening. We think that the US dollar, from a cyclical perspective, and perhaps also from a more longer-term perspective, has peaked, and there's continued risk to the downside. The US dollar, as we have mentioned in the past, is overvalued from the starting point. It used to be held up by relative interest rates, where the US was offering higher interest rates. They no longer do, with the Federal Reserve lowering interest rate to zero and doing massive quantitative easing. And so that's the US lost their interest rate differential. And from a pandemic perspective, we've seen that the American system has not been dealing as well as other regions in dealing from a healthcare perspective with this pandemic. All of these elements, plus the U.S. election at the end of the year, makes for our view that the U.S. dollar may continue to weaken from here. And on the reverse side, therefore, it means that a number of foreign currencies might appreciate. The euro is one for the reverse element where they've dealt with the pandemic better. They have a current account surplus where the U.S. has a current account deficit. And the rescue fund in Europe is certainly going to be providing some support, which should also provide some support to the euro. The Canadian dollar also might gain some ground against the US dollar, but it will be limited because it is still so tied to the American economy that the Canadian dollar will not benefit as much from the weakness of the US dollar as other currencies like the euro and some emerging countries. So just watch it. The US dollar is a currency that a lot of people have in their portfolio, and we see further weakness over the coming months.